Have you ever felt a subtle tremor in your chest as market headlines flash by? A sense of unease that whispers of forces beyond your control. It is a familiar ache, this feeling of being tossed by unseen currents, reacting to the emotional whims of what Benjamin Graham so poignantly called Mr. Market. He arrives at your door each day, sometimes jubilant, sometimes despairing, offering to buy or sell at prices that reflect his shifting moods rather than the intrinsic value of the underlying business. Many of us, driven by a sincere desire for financial mastery, find ourselves caught in this dance, feeling the frustration of conflicting information and the silent fear of making costly mistakes. While the bedrock of value investing, laid by giants like Graham and amplified by the wisdom of Warren Buffett, provides an indispensable compass, guiding us to seek intrinsic value, the modern market often presents deeper challenges. Traditional fundamental analysis, while foundational, can sometimes feel like trying to navigate a dense fog with only a single lantern. It illuminates what is directly before us, yet misses the systemic signals, the subtle behavioral traps, and the hidden currents that truly orchestrate market movements. We yearn for a clearer vision, a way to cut through the noise, to identify genuinely undervalued assets, not just by intuition, but by a verifiable, data-driven truth. Imagine, for a moment, a different kind of lens, a tool not born of fleeting sentiment or popular narratives, but forged in the crucible of rigorous data, statistical models, and robust frameworks. This is the quantitative analyst's secret weapon. It is a discipline that moves beyond the immediate emotional clamor of Mr. Market, offering an almost unfair advantage by revealing the underlying mechanisms, the patterns silently at play, and the true probabilities often obscured by human bias. It is a path to understanding the why behind every market shift, grounding your decisions in a profound intimacy with data-driven truth, rather than the shifting sands of opinion. This journey is not about abandoning the timeless principles of value investing. It is about fortifying them, deepening them, and empowering them with a new dimension of insight. It's about building sustainable wealth, not through speculation, but through informed decision-making that challenges conventional wisdom and uncovers your unique edge. We are here to demystify this powerful approach, to peel back the layers of complexity, and to show you how to truly understand the pulse of the market, not just its fleeting expressions. Many of us have felt the market's movements as a chaotic dance, a whirlwind of events with no discernible pattern, leading to that quiet dread of financial loss. This illusion of randomness, the belief that market shifts are purely unpredictable or solely driven by breaking news, can make our intuition feel like a blind guide. Yet, beneath this perceived randomness, a different reality unfolds, a tapestry woven with unseen signals. Quantitative analysts, however, perceive these true drivers, often masked by daily noise. They deconstruct the market's very DNA, moving beyond the surface-level metrics like P/D ratios to uncover deeper, quantifiable investment characteristics through multi-factor models. This is a symbolic exercise, a way to discern genuine factor premiums by analyzing vast datasets, revealing the fundamental forces that consistently influence asset prices over time. But beware, for even this powerful lens has its mirages, its own factor traps. The allure of smart beta can sometimes lead to dumb money, as popularized factor strategies become diluted or over-arbitraged, losing their edge and revealing the hidden truth of factor decay. Not all factors are created equal, and not all quantitative approaches deliver a lasting advantage. Building your data-driven edge requires a disciplined approach, a practical framework to identify truly robust factors, rigorously backtest your hypotheses, and strategically integrate them into a diversified portfolio. This involves a three-step technique. First, identifying persistent premiums. Second, ensuring their economic rationale. And third, validating their statistical significance across varied market conditions. Imagine factor analysis as a refined compass, guiding you through the turbulent seas of market volatility with data-backed conviction. It is this clarity that fosters sustainable wealth compounding, allowing you to navigate even Mr. Market's most irrational moods with serene purpose. What hidden signals might you uncover when you begin to look beyond the obvious? Sometimes, in the quiet moments after a market dip, a gnawing feeling of investment inadequacy can creep in. We tell ourselves it's the market's fault, that events were simply unpredictable. Yet, often, the true saboteurs are not external forces, but the silent, unconscious cognitive biases within our own minds. Our brains, wired for survival in a different era, can set market traps, leading us astray with confirmation bias, loss aversion, and other distortions that silently undermine our returns. Imagine dissecting those moments when emotion overrides logic, when a gut feeling compels you to act against your better judgment. Quantitative rules can serve as an algorithmic shield, a disciplined framework designed to bypass these emotional pitfalls and protect you from impulsive trading. This isn't about becoming a robot, but about identifying your personal bias patterns through a three-step behavioral finance technique, recognizing the bias, understanding its trigger, and implementing implementing a predefined rule to counter it. But even with this shield, a subtle danger persists: the overconfidence illusion. What often feels like strong conviction or decisiveness can, in fact, mask inadequate due diligence and an inflexibility to new market data. True conviction, rooted in data-driven truth, is adaptable and open to revision. Unchecked overconfidence, however, can become a portfolio killer, blinding us to risks and opportunities alike. Building your own anti-bias algorithm involves practical steps, simple quantitative checks before every major decision, predefined exit strategies that remove emotion from selling, and disciplined portfolio rebalancing rules. These aren't just technical adjustments, they are a profound act of self-mastery. Understanding how dopamine's rush can lead to chasing gains, or cortisol's grip can paralyze during losses, empowers you to construct a fortress of sustainable wealth grounded in rational, data-driven discipline. This algorithmic shield is akin to the Stoic philosopher's code, using quantitative tools to maintain emotional equilibrium and rational decision-making amidst market chaos. It's about mastering yourself quant style, so that your investing journey is guided not by fleeting emotions, but by enduring wisdom and unwavering discipline. What personal biases might you quantify and diffuse to truly master your market decisions? There are moments when the market seems to hold an unthinkable blind spot, leaving many of us with a silent fear of financial loss from systemic risks that mainstream models simply overlook. We cling to metrics like standard deviation or value at risk, believing they fully capture market risk, yet they often ignore the true tail risks, those rare but devastating events that can unravel even the most carefully constructed portfolios. To truly understand risk, we must go beyond beta, stress testing our portfolios against the ghosts of market history. This means unraveling the dark data of past financial crises, using historical context and critical theory, much in the spirit of Ray Dalio's approach to understanding economic machines. It's a three-step technique. First, identifying extreme historical scenarios. Second, understanding their underlying causes. And third, simulating their impact on your current portfolio, not just on paper, but in the quiet chambers of your deepest financial anxieties. Beware, too, of the leverage illusion. The myth that diversification alone guarantees safety can be a perilous one. Hidden leverage and the intricate interconnectedness of modern markets can render seemingly diversified portfolios incredibly fragile during systemic shocks. We must uncover the hidden incentives that create this systemic risk, recognizing that true resilience comes from a deeper understanding of exposure, not just variety. The Quant's Resilience Blueprint offers a practical transformation, a step-by-step guide for building an anti-fragile portfolio. This involves incorporating robust risk parity principles, which aim to equalize risk contribution across different assets, and strategically employing tail risk hedging, which protects against extreme, unexpected movements. This approach addresses why informed decision-making often stalls when we lack transparent frameworks, offering clarity in moments of doubt. Consider your robust, quant-driven portfolio as an immune system for your wealth. It is engineered not just to survive, but to adapt and thrive through market shocks, transforming the deep-seated fear into a strategic advantage. It allows you to face any environment, any storm, with serene confidence. What hidden systemic threats might you uncover and fortify against to truly safeguard your financial future? Too often, we feel a quiet fear of investment inadequacy, stemming from our reliance on superficial assessments of a company's competitive advantage. We might intuitively believe a strong brand name equates to a durable moat, but this moat mirage can be deceptive. Brand recognition, while valuable, doesn't automatically guarantee lasting protection against competition. The market's true drivers run deeper, beyond these common distortions. To truly dissect the components of an economic moat, we must move beyond narrative and anecdotes. This is a symbolic exercise in deconstructing moats with quantitative moat indicators, or QMS. These are measurable characteristics that reveal a business's structural advantages. It's a three-step strategic finance technique. First, identifying potential moat sources like network effects or cost advantages. Second, quantifying them through relevant financial ratios and data points. And third, tracking their evolution over time to discern genuine, durable economic moats. Beware, however, the growth trap. The myth that all growth is inherently good growth can inflict a philosophical wound, revealing how aggressive expansion without a strong, verifiable moat can paradoxically destroy shareholder value. Chasing growth for growth's sake without understanding the underlying competitive dynamics can lead to businesses that burn through capital without ever achieving sustainable profitability. Building your own moat finding algorithm involves practical, step-by-step guidance. This means utilizing financial ratios such as return on invested capital, gross margins, and customer acquisition costs alongside industry benchmarks to quantify and evaluate sustainable advantage. This process is deeply informed by the wisdom found in Benjamin Graham's Graham's security analysis a mental healing model that prioritizes objective data over emotional narratives, guiding you toward businesses with true, verifiable staying power. A well-analyzed economic moat, Quant Verified, is like a fortress of value. It ensures your investments are in businesses built to withstand competitive assaults and compound wealth sustainably, just as Benjamin Graham sought deep value in the market's overlooked corners. What hidden competitive advantages might your moat-finding algorithm uncover, leading you to truly enduring businesses? Often, a quiet fear of financial loss stems from the new normal illusion, the belief that today's market rules will persist indefinitely. This distortion leads us to assume past correlations will hold, leaving us tragically unprepared for significant market regime shifts, those profound alterations in the underlying economic landscape. To truly navigate these shifts, we must look beyond simplistic metrics like GDP. This is a symbolic exercise in unpacking the critical, often overlooked macroeconomic indicators that the pros are watching, much like Ray Dalio's approach to understanding the economic machine. It involves a three-step macroeconomic analysis technique. First, identifying key economic data series beyond the headlines. Second, analyzing their interdependencies and leading relationships. And third, building predictive models that signal potential regime changes, allowing us to see the market's unseen hand at work. Beware, too, of the central bank's shadow. The myth of their direct, immediate impact on markets can be misleading. Monetary policy often influences asset prices in complex, delayed, and even counterintuitive ways, with hidden impacts on different asset classes that are not always obvious from public announcements. True understanding requires deciphering these intricate causal chains, not just reacting to headlines. Building your own macro quant compass offers a practical transformation. This step-by-step guide involves constructing a framework using diverse economic data series and statistical analysis. It addresses the cognitive factor that sabotages critical analysis amidst conflicting macroeconomic information, providing a clear, data-driven lens through which to interpret the broader economic currents and their implications for your portfolio. Macro quant modeling becomes your unseen hand, allowing you, the adaptive investor, to orchestrate your portfolio to flow with, rather than fight, economic cycles. This ensures sustainable wealth accumulation and a profound sense of financial mastery, even as the tides of the economy shift. What hidden macroeconomic signals might you decipher to truly orchestrate your portfolio for future prosperity? We have journeyed together, peering beneath the surface of Mr. Market's emotional theater, seeking the deeper rhythms and unseen forces that truly drive financial outcomes. The quantitative analyst's secret weapon, we've discovered, is not a singular tool, but a profound, rigorous, and data-driven approach to investment. It is a mindset that transforms uncertainty into clarity and reaction into informed action. Through factor analysis, we learned to cut through market noise, discerning genuine drivers from mere coincidence. We built algorithmic shields to diffuse the insidious behavioral biases that sabotage our best intentions, moving beyond gut feelings to data-driven discipline. We unmasked the dark data of risk, stress-testing our portfolios against systemic threats, preparing for the unthinkable. We dissected the moat myth, quantifying competitive advantages beyond superficial narratives, seeking businesses built for enduring value. And finally, we explored the market's unseen hand, using macro quant models to anticipate and adapt to economic regime shifts, orchestrating our portfolios to thrive through cycles. This approach empowers you to move beyond simply sitting on your assets, as Warren Buffett wisely advised, and instead engage in a proactive, scientifically backed search for opportunity. It is a commitment to informed decision-making, one that marries the timeless wisdom of value investing with the incisive power of advanced analytical rigor. This is the path to achieving genuine financial mastery, a mastery rooted in understanding, not just speculation. Now, I invite you to take a moment, close your eyes if you feel comfortable, and recall a recent investment decision or a market headline that stirred a strong emotion within you, perhaps fear or euphoria. Instead of dwelling on the emotion, consciously ask yourself, what data points were truly at play here? What quantitative indicators might have offered a different perspective? What behavioral bias might have influenced my initial reaction? This is the beginning of internalizing the quant mindset. It is a commitment to challenge your own biases, to embrace critical thinking, and to integrate data-driven strategies into every facet of your investment process. Are you ready to claim this unfair advantage, to see beyond the headlines, and build a fortress of sustainable wealth that stands resilient against any storm?